Welcome to the deep dive. Today we're getting into the third quarter 2025 results from BBVA. You know, they're one of the world's major international banks, and our mission here is really to figure out how they manage this incredible balancing act. Record profits on one hand, but navigating, well, honestly, chaotic conditions. You've got falling rates in Europe, hyperinflation elsewhere. It's quite something.
It really is. And it's not just about getting by. It's a real case study in disciplined execution, I think. Diversification, too.
Yeah.
You look at the big picture numbers, they are pretty exceptional. For the first 9 months of 2025, almost EUR 8 billion in net attributable profit.
8 billion euros.
Yeah, and that's up 4.7% year over year.
That's a massive headline number. But the efficiency metric, the one that really jumps out, is the profitability, right? The return on tangible equity, orally.
Exactly. It clocked in at 19.7%, which is, well, it's kind of astonishing.
19.7%.
And that's not just good. It really sets them apart. If you think about their European peers, the average RT is maybe around 14.3%.
Yeah.
So BBVA is just operating much more efficiently.
Much more.
And for shareholders, well, the tangible book value per share plus the dividends paid out, that whole package grew by 17% year over year. Huge value creation.
Right, that 17% jump really shows what happens when you combine that kind of profitability with a really solid balance sheet. So let's unpack that balance sheet a bit. The capital strength seems key to everything else they're doing.
Definitely. We saw their main capital ratio, the CET1. It actually ticked up slightly in the quarter by 8 basis points. So it settled at a very robust 13.42%.
Okay, 13.42%. That's strong. But hang on, haven't they always said their target range is lower, like 11.5% to 12.0%? Why run with such a big buffer above that? Are they just being conservative, or is there something else going on?
It's mostly about flexibility, I think, and managing expectations. They have a very clear regulatory minimum they need to stay above. That's 9.13%. So even if they operate at the top end of their target, say 12%, they still have this buffer of 287 basis points over the requirement.
Mm-hmm.
And that buffer, interestingly, is quite a bit thicker than their peers. The average for similar EU banks, excluding UK Swiss ones, is maybe around 240 basis points, so they have more cushion.
Right, that extra cushion, that confidence lets them do things like the big shareholder returns we're seeing.
Precisely. And they're actually expecting more good news on the capital front. A positive regulatory impact, maybe 40, 50 basis points coming in Q4.
Oh, interesting.
Which just reinforces their position. So what do they do with that excess capital? Well, they're kicking off a share buyback program, nearly €1 billion. And alongside that, distributing a record interim dividend, EUR 0.32 per share. So yeah, aggressively returning cash.
And talking capital and strategy, we probably should touch on the Sabadell situation briefly.
Yeah, the failed transaction. Management addressed it pretty directly on their call. They framed it as a missed opportunity for everyone involved. But the key takeaway was, look, that chapter's closed. The focus now is purely on running the core business, executing their own plan. No distractions from M&A for now.
Okay, makes sense. Let's shift gears then to the engine room. How are they actually making this money? Because you hear so much about falling interest rates globally, yet their core revenues, that's net interest income plus fees, they grew 4.4% just in the quarter. Seems counterintuitive.
It really speaks to their momentum, I think.
Mm-hmm.
Strong customer activity kept lending growth going at they called it an excellent pace. 16% year over year in constant euros.
16% loan growth. Wow.
Yeah. And that volume growth meant net interest income jumped 18% year over year, and net fees were up 15%. Again, constant euros. Basically, volume is outpacing the margin pressure from rates.
And looking ahead, their strategy seems built on the idea that the worst of the rate cuts is behind us.
That's the view from management, yes. They believe rates are at or very near the terminal rate, sort of the floor in their main markets. Think about the shift. Beginning of 2024, the market expected maybe 4% in Europe, Spain.
Mm-hmm.
Now they see it settling around 2%.
Big drop.
Huge. And Mexico, rates were over 11% at the start of the year. Now the policy rate's 7.5%, and they expect it to bottom out around 6.5%.
So if rates stabilize, does that mean they can finally get some stable pricing power back on loans?
That's the idea. They've absorbed a lot of the pain from those rapid rate drops already. So management is now talking about relative stability in customer spreads going forward. Rate stability should let those core revenues keep growing, helped by the loan demand we just mentioned.
Okay, let's dive into the regions then. Starting with Mexico, it's just such a powerhouse, right? EUR 3.8 billion profit in 9 months. What's the magic there?
It really is scale and just executing incredibly well. Mexico's where BBVA's competitive advantages, their moat, really shine. Lending growth is still solid. around 10% year over year, and they're focusing on the profitable bits, consumer loans, SMEs.
The retail side.
Exactly. And they have this amazing structural advantage, like holding 44% market share just in payroll accounts. Think about that deposit base.
And they seem to be holding their own against the newer digital players, the neobanks like Nubank, that are pushing hard into Mexico.
Absolutely. You see it in the profitability numbers. BBVA Mexico has a return on equity around 28%. The peer average is closer to 15%.
Wow.
So while neobanks might attract some deposits with flashy rates, BBVA leverages its scale in things like credit cards, where they're still gaining share. And that brand loyalty keeps deposits pretty sticky. They can compete.
Right. Now, there was a little note about asset quality in Mexico. They lowered their cost of risk guidance, which sounds good, but they mentioned this quarterly hit from an IFRS 9 model recalibration. For listeners maybe not deep in bank accounting, what is that IFRS 9 thing and why does it matter?
Yeah, it sounds like jargon, doesn't it? Basically, IFRS 9 is the accounting rule for how banks estimate and provision for potential loan losses. The key thing is it's forward-looking. Banks have to estimate future expected losses based on economic forecasts, not just wait for defaults to happen.
Okay.
So the annual recalibration just means they updated their economic models, plugged in new forecasts for GDP, unemployment, things like that, and adjusted the pot of money set aside for potential future losses.
Got it. So if the economic outlook improves, like maybe a better GDP forecast.
Exactly. Then your expected future losses go down, and that allows you to lower your overall cost of risk guidance for the year.
Even if the recalibration itself causes a blip in one quarter's numbers.
Precisely. So the fact they guided GRR down to below 340 basis points shows underlying confidence in Mexico's economy, despite that technical adjustment.
Makes sense. Okay, shifting over to Spain. Domestic operation, EUR 3.1 billion profit. The economy there seems to have some decent tailwinds. GDP forecast upgraded, tourism strong, EU funds kicking in. But here's the puzzle. They're apparently choosing to lose market share in mortgages, in their home market. Why?
It does seem counterintuitive, doesn't it?
Yeah.
Spanish economy looks okay. Why pull back from mortgages?
Yeah.
The answer seems to be pure capital discipline. Management basically said, look, we do not see value in growing the mortgage book at these prices. The margins are just too thin, especially with rates where they are. It doesn't meet their internal hurdles for profitability, for return on capital.
So they're actively prioritizing higher returns over just grabbing volume or market share. Is that risky long-term seeding ground at home?
Well, there's always a risk when you give up share, yeah. But it's a very conscious trade-off. They're taking the capital that could have gone into low-margin mortgages and putting it into areas with better returns. Lending to mid-sized companies, that grew 11%. Their corporate and investment banking, CIB, that grew 18%. It's a clear signal. They won't chase volume if the price isn't right. Optimizing return on capital is paramount.
Right. Okay, from disciplined Spain to, well, the chaos zone. Turkey, EUR 648 million profit there, which is impressive given the environment. 40% policy rate, massive inflation. How do they even operate profitably?
Turkey is just. It's a masterclass in managing complexity, mostly driven by regulation, even though the policy rate is super high, maybe starting to ease slightly. Their net interest margin, the NIM, the spread between loan earnings and funding costs, it's under constant pressure.
But why? If loan rates are so high, shouldn't the margin be wide?
You think so, but it's the funding side. Regulators require banks to hold a certain amount of Turkish lira deposits. That forces all the banks into fierce competition for those lira deposits, which keeps the interest rates they have to pay extremely high. Funding costs are sky high.
So high funding costs eat into the margin from high loan rates. Got it. So how did they manage to improve their NIM by 65 basis points in Q3? That sounds like some clever footwork.
It is. It's sort of operational arbitrage, you could call it. Since getting enough cheap customer deposits is tough because of those regulations, they strategically used other cheaper funding sources when they could. Specifically, the repo market short-term borrowing using collateral.
Okay.
By carefully managing the mix between those expensive mandated deposits and cheaper wholesale funding like repos, whenever the rules allowed, they found a way to widen the margin significantly. Pretty smart.
Wow. Managing that day-to-day must be intense. What about the rest of South America?
South America overall was strong. Contributed EUR 585 million net profit. Colombia and Peru did particularly well, quite stable. The main headache, predictably, is Argentina. The government there pushed real interest rates incredibly high, think policy rates, near 60% when inflation was only around 31%.
Ouch.
Yeah, and that directly stressed borrowers, leading to some asset quality deterioration.
And BBVA's reaction.
Very targeted. They immediately pulled back on lending in the riskiest areas like credit cards and unsecured consumer loans just to contain the damage. Again, it's that discipline. Protect the balance sheet first. Don't chase volume and that kind of volatility.
Okay, let's wrap things up looking ahead. Strategic growth pillars, digital seems foundational for them.
Absolutely. It drives efficiency, but also customer growth. They pulled in a record 8.7 million new customers in the first 9 months.
And the majority digitally, right?
Yeah, a massive 66%, two-thirds, came through digital channels. It shows the power of their platform.
And they're using that digital strength to expand, like the new banks in Italy and Germany.
Exactly. Those are part of what they call the rest of business unit that also includes their global CIB. And yeah, those Italian and German digital operations are apparently doing better than planned. They've already gathered EUR 10 billion in deposits between them. It shows the model works, even in competitive European markets.
Sustainability is baked into their targets too, isn't it?
Very much so. It's not just talk, it's a business line. They channeled EUR 97 billion in sustainable business in just 9 months, a record pace. It shows they're really integrating it into their lending across the board, retail, corporate, investment banking.
Okay, and finally, the big ambitious goal. Corporate and investment banking, CIB. Profits were great there, up over 30%. But they want to double the whole global CIB business in just 4 years.
It is incredibly ambitious, isn't it? Doubling a global CIB unit that quickly. Wow. To get there, they're focusing on two main things. First, cross-border trade finance, using their network to help clients operate internationally. Second, leveraging things where they already have an edge, like being a key market maker for Mexican peso bonds. Use that position to attract big global institutional clients who need that access.
So, boiling this whole deep dive down, it feels like BBVA's story right now is about two core things. One, exceptional profitability, driven by really sharp execution in very different, often tough markets. And two, a very clear, large-scale commitment to returning capital to shareholders.
I think that's right. The focus maybe shifts now slightly. They've proven they can optimize the core franchises like Mexico and Spain. The next big test is scaling the growth engines, especially that CIB expansion plan. Can they really double that business in 4 years organically while staying so disciplined on capital? That's the challenge. Flawless execution needed.
Yeah, it really raises a final thought for you, the listener, to consider. If they pull off this CIB and digital expansion, how quickly could that change the bank's overall shape? Could we see a future where, say, Europe or the global CIB business starts challenging Mexico's dominance in terms of profit contribution? That geographic mix is definitely something to watch over the next few years.